That's true. All right, good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for Friday night, February 17th, 2023. We'll start with the swing portfolio update. We'll see some evidence of why yesterday's decisions to, trim swing trades at the peak of a reasonable profit paid off pretty well. I mean, it could have gotten out of positions today, but the sell-off was so quick that if you're managing a lot of positions, unless you have those stop orders locked in, it could be problematic. So we'll start just at the top alphabetically here. So Alcoa was one of those that we locked in yesterday. It opened here and then dropped like a rock in the first 30 minutes and then stabilized here. Now, all of the metals did that. And so we'll see that I think in U.S. Steel I added an entry at this location. So I didn't put it on this one. I wanted to have some exposure going into the weekend. And I chose, I think, U.S. Steel instead. But that would have been, this was a candidate on my mind because I saw the harsh sell-off that had cleared the deck, but which did not fail further going into the weekend. And so I considered that on this one, but did not take it. So this is an example of the peace of mind you get from cashing, especially on that one, which was almost a 4R win on that trade. So Alcoa, we're flat. Cliff, this is the same pattern that we saw in Alcoa. All the metals had this characteristic where yesterday we took that trade and exited on the PSAR flip, and then today was a gap to here and then a harsh sell-off and then stabilized. Now, Cliff didn't make my cutoff because that was even weaker than Alcoa, but it did have the same characteristic as the holding support. The only advantage to this one was that support held higher than this support, but I was more persuaded by the U.S. Steel position. So, again, happy to have closed that trade and just noticed this one and flat on Cliff going into the weekend. Let me zoom ahead to U.S. Steel so we can see that one in the same sequence. I guess it wasn't. Maybe it was emerging markets. I thought I took U.S. Steel. I should have taken Alcoa, now that I look at it. So U.S. Steel, on the other hand, we had closed this trade on two positions. I remember this one now. So this one was one where I had time to put an intraday swing on and then just cashed it at that hook. Didn't get this other piece, and then this was the furthest away. Yeah, I must have been, maybe it was emerging markets. So anyway, the metals all had the same characteristic movement of the strong previous trade, which we exited, and then they all featured this strong sell-off. This was just one that I used. X is my primary metal when I'm looking to trade on the short side. So I was able to get a gift of about 1.5R on that one. So CVS, this was the legacy of a Godzilla that had sold way off here, and then we tried the Godzilla trade in here after the positive gap up. It got an initial burst and then just ground down, so we held it, stopped in reverse, closed, and now it gave us a COTA 2 today near the end, and because this still feels like it's in this motion of a Godzilla, I decided to give it a shot because the minimum manageable risk box was larger than and outside of the daily frame. So this had no inclination of panic selling back to support levels. And so I treated this as a COTA 2 and going into a quiet weekend, and I'm looking to make gains up into this region, and then if it can get above the 5-day high, then I think this is a Godzilla that is gaining some traction. So that's a long way around of saying caught a two swing on a Godzilla in the normal life cycle with a wide MMRB. Check or hold? This is Devon Energy. You will recall that we had a swing that we got smashed on a overnight gap. We used the violent move intraday with a much tighter stop to get our money back that was lost in the gap. The rest then yesterday this thing sold off decisively, and today gapped down further and concluded. So I'm actually prepared to SSC this one next week early. If it breaks above 54 without further sell-off, then this is one that could really go in the energy sector. But I stayed away from this on a swing trade because it's radioactive. This is, let's see, EA, Electronic Arts. This was a stealthy Godzilla down to here. It's had a couple of false starts that we earned tiny little fractions on. And then today, interestingly, this is the support level that it's been holding consistently. Today, it gapped down and then closed relatively strongly. So on that move, that felt like a washout. So on the PSAR flip, I'm just going to give it another shot and put the standard trade on until this either is going to fail decisively or it's going to work. And my intention on that intraday is that if that fails here, then I will pile on that thing to the south as a continuation of the Godzilla. So we are long Electronic Arts over the weekend with a swing position. Emerging markets. This is one that sold off harshly. There it is. So this is one where we were long and lost 2R on the gap. Today it gapped down harshly, but held support and gave us a PSAR flip. So I'm just treating that one as an SSC, and we'll see how that goes. This is one that I will stop and reverse here if that fails. But the globals have been stronger than the U.S., and so this looks like an opportunity to play this as almost like a channeling. Mexico. So this one was a very nice long trade, and on that explosive move up yesterday and selling off, I wanted to preserve that. And then today it gapped down, sold off, and then resumed. And as soon as it crossed the dragon, I went ahead and reinitiated with the standard risk box. So we're long Mexico, and I could even be tempted to add a position if it breaks above the 5-day high. But the turbo on that one will be on a 3-minute chart. Brazil, on the other hand, its partner, has just been kind of dead money in here. And although I appreciate the Kata 2 style action here, I want to see this. There will be enough time to play that if it breaks above the 5-day high, and that will be a standard 3-minute turbo. But I was not ready to make a over the weekend hold on that one. But Mexico had much more explosive energy in it. Like, if you see this is not explosive energy to buy it. People are not rushing in to buy this. In Mexico, people rushed in to buy this twice already. Here, where it broke out of this, that was a big, powerful surge. The pullback held support, and then there was another powerful surge, and today it didn't fail. That has a lot more buying energy than Brazil does, and the market is smaller. So That was the one that I was ready to hold over the weekend. This is IP, and we had a nice two position short, which stopped and reversed, and the stop is still in place here, and this thing has just been dying on me, and I just refuse to get out of it. I'm going to hold this line right here until it breaks above here, or stop and reverse here. So one of those two things is going to happen inside this, like yellow zone. It's either going to fail through here and I'm going to get short, or it's going to break out of this and I'm going to add a position, and I'm not touching the stop until one of those two things happen. I'm just going to be stubborn as a mule on that one. This is real estate, and we had like a micro win here and a scratch, and it's just been directionless. And even though this hit the PSAR flip, this has been so listless I was not persuaded. But I could be tempted to start a turbo trade on 3 minutes next week, because there is a nice move available to the 5-day high and then the 10-day high. So that there was no hurry on that one. Real estate is not one that just explodes in that sense. So this is McDonald's. We're finally starting to get some traction on this one. This was a long that scratched. Then this was a collapsing dragon that paid off. This was a COTA 2 that paid off to here yesterday. And then today it did not fail, and gave us that R10 wiggle. And so that's an emerging dragon. And standard risk closed well. And I made a decision in here to continue to hold it over the weekend. I like McDonald's in that position because it has cleared this previous resistance level. And I have some, I'm keeping my stop down here, but there's some wiggle room on that one. So again, emerging dragon type of a pattern. Marijuana was a nice trade to the short side, a COTA 2 reversal. On that failure to fail and that emerging dragon, we added a position yesterday, watched it come all the way down to here, and then today it opened here and started selling off, so just cashed it. In retrospect, I should have exited up in here. This has been so vulnerable. I like that it held above the key support level of 7, and I thought for a moment about re-entering here, but I'm not in any hurry on this one, and we'll just wait and see on Tuesday or Monday. I got to check to see if the market's open Monday. Check to see if the market's open Monday. I actually think it is for President's Day. But on the market open, okay, Tuesday, yeah. So on Tuesday we'll see if that little COTA 2 continues. I'll be willing to get tentatively back into that one. Clean energy. This is the one I was thinking of, not the U.S. Steel. So this one, we had a really nice short, an SSC, and we were able to pile on a second position with an emerging dragon, and then a 2-hour battle drill for a third position. And yesterday we closed it here, and then the market closed here, and then today it sold off harshly, but then stabilized, and then broke through the PSAR with a COTA 2. And I felt like, you know what? There's a really nice move back to the 5-day high, and so we're going to try that one with a standard risk, and off we go. We made markets money inside this, and I'm just rolling that forward into that position. So that's one I was willing to hold overnight or over the weekend. The S&P Just, I'm not swing trading that one, but after this, 4 days of just miserable sideways, today it harshed all the way through the support, established a new lower support level. That's not good. The only positive thing was that there was some late buying pressure and the approaching the PSAR. So tentatively, this could be a recovery move on Tuesday. But this looks to me like folks just were bailing out of positions before the long weekend, and then it just found its natural support. So I don't treat that as a panic selling. This just looks like reducing long weekend risk to me. Treasuries. Now, this one, so TLT was at the top of the reward to risk ratio. The way I've been sorting this thing for the last couple days, I've been sorting by reward to risk ratio, and Treasuries was at the absolute top. And so when today, at the end of a long, harsh sell-off, and this is your 10-day high here, and that's your 5-day high here. Today's range, yesterday closed poorly, which meant that a retest of the 10-day high was like a 7-to-1 using just a standard risk box of a daily range. It was 7-to-1, 6, 7 to the 10-day high. And then when today gave a morning hook and hit the PSAR flip early, I'm in. Standard risk, closed well going into the weekend, and now there's still a 7R trade available to there. And even if it only gets halfway up the stack, that's 3-to-1. And so I really like that discipline of sorting by the auto framer reward to risk ratio. So you'll see that again in this week's in the weekend report and the daily report. I'm liking that as an approach. Tesla was an orderly COT 2, so we had this COT 2. We missed that one, but this COT 2 and SSC sort of approach with the standard risk, that worked really well. We added a second position on the 2R battle drill, closed it yesterday at the PSAR flip just to make bank. It harshed today, but then it found support still within the COTA 2 framework. And there's your reversal, and there's your PSAR flip 2 hours before the close. So just initiated here. It closed pretty well, and I could be tempted to add a second position here if it closes above 216. And so that's and we already saw U.S. Steel. So that was just the opportunity intraday trade on the 30-minute for about 2R. That felt pretty good. So that's the swing trade portfolio. We'll shift to the turbo trade. So here was today's sniper trade of the day. It's a turbo trade on one of the ones that we just saw. So that was yesterday's close. Here's the gap down. Here's the OR3. Here was the first breakout of that. I was looking for it to get back to the close on a standard risk box. It rolled over and failed immediately for -1. I took that as a stop and reverse with the standard risk box. It reversed immediately, so I took about a 0.5 loss on that one. Waited for it to break out of the OR3 and just reinstitute, and it was close to the PSAR flip. So just reinstituted the entry here on a standard risk box. So we're in the hole -1.5 on that one already, but we're looking at this with a standard risk. Check or hold. So that thing takes off like a scalded ape. So with this stop here, really by this point you got to get your stop to no lose. Excuse me. So now we've locked in that much. Now as you notice this little pullback and go, that was so quick that the R10 didn't even wiggle. And as you see it taken off, you can now start running this up to here, up to here. You see it close here. To me, you got to have your stop at least by the spine of the dragon so that you can lock in this much. And on 1 unit of risk, that gives you've locked in about 2R, which now pays for the minus 1.5R. So if this just hits, then we'd be okay. We're still net positive for the day. Ends up trying a couple times to recover, but it can't get past that peak, and this is not persuasive. So when that fails, I just take the guidance from the PSAR, and this failure to follow through triggered me to treat that as the stop and reverse, because I can still see this move, and then this just felt like that was the limit, and now there's a good reason to believe it can get back to here, which is about 3R off of that risk box. So I take that one as a stop and reverse. Notice that the RL10 also went from summer to fall in here. And basically, all of the joy from the spring kind of got wasted in the summer because it really didn't go anywhere. And so it rolled into fall pretty quick in terms of the MACD. So again, for those of you that who are new to us, the color-coded RL10 comes from the TC2000 package, where we interpret the seasonality of MACD and turn the price RL10 the color of the MACD season. That way you can use all of the screen for price action without having to see the MACD histogram and the 4 seasons. So this one has an orderly sell-off and then can't fail anymore, and then that's enough for the R10 to reverse. And that leads me to take the exit at the skin of the dragon, locking in +1. Check or hold. That leads me to take the there's the PSAR flip. There's the belly of the RL10. The dragon has rolled up. R10 has crossed the dragon. PSAR flip. And then here's the swing low and a higher low. That's a COTA 2 all day long. And now what we would say is we need to see a price break above those peaks of the RL10. We need to see the emerging dragon, and that makes this space in here the tactical trade space, where we've got one position on, and we're fighting to get our stop above the entry as soon as we can in order to lock in this little wedge of no lose plus dinner for 2. That's important because we're not going to lose money on that trade, and we will have taken our risk, which was this, take our risk off the table. And then it's just simply a science project as we wonder how much will the rules return to us. So now it's testing that support level. So this is either going to work or it's going to fail, at which point I need to have a stop at least like there. I wouldn't be offended if you took the spine of the dragon, because either one of those gives you the no lose plus dinner for two. Okay. So by this point, you want to have your stop to either to position 1 or 2. Both of them work as this thing starts to proceed higher. What's useful to note here is that in the middle of all this choppy price action, you see that the R10 has moved from spring into summer, and you're getting higher lows. So there is sort of a persistent upward move, and the dragon is still up, and the PSAR is up, so everything's up. And with your stop at either 1 or 2, you gave it time to resolve this test. It's testing this price level to see, there were obviously plenty of buyers that came in here, and they cashed their wins here. When they disappeared and nobody followed through, they captured their wins. And then the buying pressure started again here rather than down here. So that's the secret of the kata 2, is that you're recognizing that there is a higher low, which is where the buying pressure comes in. So this price action here is testing that support level, and you're in a nice position here because you're not going to lose money. You're either going to make this much or this much, and you're giving it room to resolve this tension, and then that may be in your favor. We can think about adding positions later. Check or hold. That turns out to be a really important lesson. And it just kind of peters out and gives us a nice exit at the PSAR. And that's the nice thing about the PSAR, is that it just kind of marches along and does what it does. And when you get the summer turning to fall, and then the RLXD, that's plenty. And that gives us, on 1 unit of risk, about a +2. Check or hold. Kata 2. Half an hour gain routine, starting to slow down. Notice that there were 3 surges up on this one. The first one off the bottom was sharp and steep, fast and steep. The second one, not quite as big, and the angle of the dangle there was a little bit weaker. Still a kata 2, but now this one is even flatter and runs out of steam sooner, so you can almost feel like, an A, B, C kind of energy, that this thing is running out of steam as it gets close to the end of the day. And so less volume, less volatility. It feels like its work is done here. and then it just kind of grinds into the close. But the nice thing on this is that for the swing trade that we have, this is in name that target. Yes, it is Treasuries. And this very positive close. So we made enough money on this one here to fund the swing. So that this would be the turbo trade. And then if we go back and look at Treasuries, that's what this looks like in the context of 5 days and 10 days on the 30-minute charts. And that's a reason to hold the swing, because it's at a swing turning point. And just back to the 10-day high, which was a 7-to-1 reward to risk, that's one that I'm willing to hold overnight with 20% of the position. So the overnight risk on this was fully funded by the intraday trade. And Treasuries as a target was triggered by how strong it was on the reward to risk. It's still 2.8 to 1, but yesterday it was, I think it was either 4 or 7. It was at the top of our stack. Check or hold? Okay. Let's see. Let's look at the traders just while we're here. There was a handful. And then we'll get into the weekend. I see Woj just added one. Let's see what he's done for us today. So he's got his usual lineup of Devon, U.S. Steel, and NVIDIA. He gets +3 on Devon today, getting that beautiful run down. Tries a resumption, it fails, but he reverses here. That probably nets to 0, so 3. He gets the same smashing move down on U.S. Steel, stays out of the chop, doesn't get this one. This move here alerts us to the possibility of X continuing to fail. And then in NVIDIA, he gets a -1, but he's 5.8 for the day, which recovered yesterday's. He had that bad headache day yesterday and still tried to trade and was down -5. So today recovers all of that and leaves him netting 14.7 for the week, even with yesterday's 5-hour loss. So he more than makes up for it today and has a 15-hour week net. This looks like Nolan and Devon. Now I've got him just looking at Kata 2s, and so he gets this Kata 2 payoff and a scratch, so net nothing. But I want you now to start also marking up your OR3s, because that's going to be a pattern that we will also work on. And then here's this is an SSC to the upside. This could have been a Kata 2, which would have paid, wouldn't have lost, but at least you noticed it. And he's treating it as a sideways quiet channel, and also going into lunch. So I don't object to that one. But now that you've got the discipline of just the one pattern, make sure you start marking up the OR3s. Here's Satya with the U.S. Steel on 3 minutes, and he brings home 3.3. There's the OR3. There's his entry short. Standard risk box. On that first hesitation, he makes 3.1. There was a re-entry opportunity you would not have lost money on. He tries the SSC, does a quick stop and reverse. That one scratched. This was -1. Stays out of the chop. Plays the collapsing dragon, gets paid, and gets paid again on the re-entry this time. So netting 3.3. Well done. This is my brother working on applying the same indicator set that we're using on the very long-term sniper. He's looking at adjusting and applying this intraday. So it looks to me like what he's got here is oversold on Williams %R and reversal. It crosses to the north side of the dragon. Hits the PSAR. He's long to our battle drill and exit for 3.3. It does not fail below the VWAP and resumes. Entry to our battle drill, to our battle drill, to our battle drill. Now he's got 4 positions in and all out at the PSAR flip.
Yep.
13.8 R out of this sequence. Everything north of the VWAP. The PSAR is your friend. The flip is the deadly warning of alert. It's like a rattlesnake. Notice how the PSAR Bollinger Band on this starts to flare, and the MACD violates. That's your early warning of the flip coming. The Williams %R also warns you. That's such a nice exit. And that's 16 for the day. Yeah, 16 R net for the day. Pretty nice work there, Bill.
It works really well on the long term. So.
And then and then we already saw Woj. Let me. I heard you. Did you have something else? Good to go? Okay. I thought I heard you talking in the back. All right, so let's go to the report. All right, as always, we'll start with the weekend report and then go to the daily. So for the weekend, bullish normal, reasonably strong, although this was a little bit of problematic weakness, not painful, but we're also mindful that risk Z is giving us a risk off, so we don't know that it's just going to stop there and reverse. That would be nice for the long side, but that's also what it looked like here, and then that was a big smashing blow. So this is a compound critical state near the 10-day low. Still strong representation in the globals. ETF2 is at 90% exposed. So generally positive in the world, with a hat tip towards Europe. In the RLFF regression line fractal daily, if you zoom in, you can see the, this is the way I track Where's my little marker? There we go. This is how I track the seasonality of MACD for uh, monthly, weekly, and daily MACD conditions as a quick visual. Like I group these are all the daily in the fall, these are the daily summers, a couple daily springs, and a bunch of daily winters. So that gives me a quick grouping by type. What I'm liking about this is the sort of the Kata 2 formation. This was a warning shot today. It's got to hold this next week, otherwise we're back into this channel, which we spent time in, and then the breakout here was helpful, but this rollover is problematic. So it's got to find support here and continue, or it's going to fail, and then the worry is back here to the RL270. So that actually makes this a really crucial support level and compound critical state, because the possibility of large moves in either direction there. This was not really a decisive move from the last time it was at that level. You know, when it was here at that level, it could not continue up after leg 1, leg 2. This time it fell. This time it fell. This time it gave a marginal up. So that's actually improving price action, right? And we see that reflected in the way the RL90 is cruising, and that the RL270 bottomed out and is slowly rolling up. So this is signs of a recovery, but that doesn't predict anything. It just describes. This is a warning of a compound critical state. So this is a price level to the downside. This is a price level to the downside. If that fails, then it's back to here. But if this breaks out above here, then it's back to here. So that's what makes this compound critical state. The regression lines just make that so clear, to me anyway. When we widen our lens, step back even a little further, and we look at, now the bars are 3 days and 9 days. This was from that peak of 380, or 480, excuse me. Now we see that smooth out. We see that Kata 2, and we see the summer, fall, summer, and it's still on the 3-day. It's still holding right inside the dragon, and that would be an orderly move to here, and then to here, and then to here. So that's what your price ladder on the upside looks at. But this is the crucial price level of all time right there. That's sort of the ultimate yellow zone. If it fails, then it's here, and then it's back to here. So that's where we are on the 3-day. If we look at the 9-day bars, this is the COVID. And this was the beautiful run out of COVID and the PSAR flip. Notice how important PSAR flips on the 9-day are. And this little healing process we've been going through here, this latest PSAR flip, that's your PSAR level. And so we've actually had a little bit of joy. And, so we've got that much buffer. And then, so this is our critical state. Can get to here, or can fail and fail further. Like if it falls below this, look out below. but relatively sanguine right now. That's nothing to worry about. There's nothing ever to worry about in life. I mean, it doesn't last forever anyway. So we're just going to manage that in a professional way. This one really highlights the importance of where we are, though, because that puts the entire move from 480 to this painful low into context. That's as critical a critical state as you could ask for. The market 150, so now we're back to daily charts. This was a warning shot. Target, breakout to the upside, and then next target. Critical state, I've said that enough. Zooming in on just the last 30 days, you can feel that COTA 2 and the gentle decline. This was not good. This was not helpful. I just think that was protecting the gains from this long grind at the long weekend. I don't see that as panic selling yet, but I could be persuaded otherwise. Like if this fails below the 10-day low, the next support level is probably here. But if it holds, then it's got to break above this 10-day high, and then it'll be very strong. That's the 30-minute over the last 30 days. So this was that gap down. It held support, and it actually closed pretty well. So again, I just see that as people cashing in the gains and protecting the profits from this move up. And there was some residual buying pressure. So that does not look like panic selling at the end of the week. That just looks like prudent trimming. All right, BMR portfolios. EFA, that's the non-U.S. Euro-Asia blend. That's pretty good. These are all your globals. Now, they gave back this week, but and the U.S. was a little better. Tech has had one good burst, but not much follow through this week. So, a lot of backing and filling this week. This looks like profit taking in the globals. We'll see. ETF 22, it adds the XL series. So industrials are the strongest, then finance, then tech of the U.S. new ads. While the weakest XL series, energy, utilities, healthcare, and staples. So those are all the defensive plays, and that's the cyclic energy. So it really, tech, finance, and industrials, the economic engine is still looking pretty good relative to the other sectors. ETF 32 adds country indexes. So the Euro 350 and China. China got smashed this week. The U.S. mid-caps, MDY, that's actually pretty good performance. So in terms of being the leading candidate in the U.S., that's probably as good as you could hope for. Was there anything better? The Russell was marginally better. So when the mid caps and the small caps are outperforming the S&P, notice that was down a fraction and not up as strong. That's actually a positive sign for growth for the U.S., and especially with tech being among the stronger sectors. So that feels like a slowly recovering U.S. with tech in the lead and being bolstered by targeted buying in mid caps and small caps, with the large caps lagging. That's how I read that. By the large caps, I mean the S&P, and then also the Dow is lagging a little bit. So this is a shift to U.S. growth. Let's see, Dow 30. Cisco just running rampant. And this was a reason to hold the McDonald's swing. And I like Microsoft's chances going forward. Once it gets out of this little funk, it has had a pretty good month of recovery. And Apple is the other tech staple that had a pretty good weekend month. So that's where it's old school tech is really dominating right now, because you have Cisco, Microsoft, Apple, all looking pretty good. We'll look at the let's see here, and volatility stats now. Yeah, and my brother's going to go over the indicator set after tonight's review. So if you want to stick around for some bonus coverage, that'll be worth your while. Um, let's see, annotate. So again, we're looking at the top 30 ETFs by average daily dollar volume over the last 30 days. We're looking at the ATR percentage. So everything on this list is volatile. Those that are in green have abnormally high volatility compared to this peer group, so that makes them very tradable. So here's gold miners, Brazil, oil exploration, consumer discretionary, biotech, semiconductors, and energy. Yes. Pretty good trading targets. This should get your attention. Treasuries with a 1.51% daily volatility percentage are as volatile as the market itself. So this is not the risk-free rate of return. This is a trading instrument that often moves opposite to SPY and is a valid short-term trading target just as an asset class. Shorter term, don't think of it as different than equities. It's just another form of equity. All right, shifting to the daily. Let's get to dashboard 1 real quick. Lots of auto framers because of today's little sell-off. You got a 5DD in AXP and a 5DD in ExxonMobil. That should be a target because that has been so good for so long that 5 days down could actually be a buying opportunity. It was down almost 4% today. Got a lot of residual strength to rely on. But ETF 30. Again, lots of auto framers. No 5DDs here. Weakness in energy across the board. Standard numbers for mechanical trading for the auto framer. I still like, and I'm going to stay with treasuries because I'm already kind of committed to that one with an open position. But I like that Microsoft and Intel are in the mix, and that emerging markets swing that I have, 4.3 was just too good to pass up. And there's your mid caps and the Russell. So there's favorable swing trades, and those are the two strongest U.S. indexes. So that ought to be on your framing radar as well. Squeezes, regression line, fractals, handful of Godzillas here. Devon Energy is the only volatile Godzilla, so that should be on your short list. And then these are all stealthy Godzillas. There's our little Electronic Arts stealthy Godzilla. And again, I'm going to keep playing that one until it either collapses or rebounds as a value play. But all hail King of the Monsters. Nothing in our tactical symbol set. Among the one-day movers, there's almost 4 sigma there. OGN was that one my brother played today for 17R. That's still in play. The OG. And ALB probably will get his attention too. ALB. He instantly saw that too, even as I was drawing the circle. So this is the, I'm just sort of resorting this one now to have the, the auto framer stats. But now I'm sorting it by the reward to risk to the 10-day high. So if that was the 10-day high and this thing is sold off a certain distance, and that was today's range, if we just called that R, and then if we were able to get an opening inside and then take out the mechanical entry and then use the daily range as a 1R risk, then this reward to risk ratio here is simply counting how many of these daily ranges there are on a test back to the 10-day high. So in this case, this would give you a reward to risk ratio of 3-to-1. So wood, the lumber ETF is 5-to-1, Microsoft is 4-to-1, Devon is 3.9-to-1, treasuries are still 2.8-to-1, and so on. And then I'm showing this blue line as the cutoff between 2-to-1 or better. So everything north of this is 2-to-1. Everything below that is less than 2-to-1. So all of these down here are very close to their 10-day high. These are the ones that are the furthest away from their 10-day high. So if there is a recovery, like treasuries we've seen the first day, there could be a nice auto framer swing trade. That's the whole idea behind the auto framer. And then inside here you can see the intraday R10 and then the R stat to give you different, the different values for potential risk boxes for the intraday or maybe even the swing trade. Okay? So I'll leave it to you to play with that one. What stands out to me on our tactical symbol set, sorted by Z5 volatility, is that Devon Energy and Bitcoin have the 5-day volatility and only U.S. Steel on the 1-day, so that's automatically in play. Something special happened with U.S. Steel. It was all that downside move. So that's in play. Only a few things in the summer. None of the ETFs are in the summer. So that tells you how strong Boeing, Cisco, Walmart, United Health have been. And Walmart, exceptionally in the summer, that's just, it refuses to lose. multi-time frame NDX. Lots of weakness today and recently. Just a few things showing strength. Merck and McDonald. This was the reason to be willing to stay long on the McDonald's swing. Procter and Coke starting to wake up. This mostly energy and materials. And some weakness creeping into the globals. And finally, the frog list for trading value. This is looking at some stats that favors large range percentages for daily range. Like Ethereum is moving 7% of its price in its daily range. Look at Alcoa, Clean Energy, and Tesla moving as a percentage of their price. And then you multiply that by the frog box number or frog quality number to come up with a trading value ratio sorted by largest ratio to smallest. So the ones at the top are the ones that have the best combination of large, reliable daily range percentage. And that's what we're looking for. That's something that I define that as having trading value. I'm just doing this on my standard 30 Dow and 30 ETFs. Could you do this on everything? Yes, you could. And you would get some interesting candidates for large, reliable moves over the last 30 days. Nothing unusual in the rest of the market mosaic, except I just want to reemphasize that before COVID, there was only one downside and upside extreme volatility, whereas after COVID, compared to long-term stats, look how much more volatility there is outside of the normal. How big those moves are and how sharply they turn. This is a swing trader's heaven when you see that characteristic of volatility. And you can see by looking at the RL30 slope of the S&P, you're getting that slow improvement of the COTA 2, and it's at a critical state at the upper limit of normal volatility. And that's why it's either going to come down to here like it has the last two times, or it's going to continue higher. But that's why we got to be prepared for a short-term pullback. So be advised. All right, that's everything I got. Bill, do you want to record this or just rehearse this?
Let's just rehearse it.
I mean, I could. All right, let's just rehearse it. I'm gonna stop the recording and hand off.
Yeah, it's not official material.
Yeah. Okay, so that's a bonus for folks that are hanging around and putting in the sweat equity. Got to respect that. We have it. So let me pass the. Let me stop the recording.
The baton.